Good evening, my friends, and it's the 5th day. We are great and successfully completed 4 days of refresher course on 360-degree of annual report organized by the Corporate Laws and Corporate Governance Committee, hosted by the Vijayawada branch of SICA. And this is the 5th day on the accounting standards applicable to small and medium companies, auditors, and directors' responsibility in compliance illustrative disclosures, and accounting standard 1, 2, 3, 4, 5, 7, 9, and 10 and 11 by today's resource person with us, the CAS Jagdishan sir. Before going to the further proceedings, now I request all the members for the raise for the motto song. It is not required to stand. I request all the members to put your right arm at your heart, sir.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्मिमाणः निर्मिमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता
Thank you. And now I request our branch chairperson, CA Gaddam Shrita Shirin Garu, give his welcome address.
Speaker of today's technical session, CAS Jagdishan sir, and colleagues at Management Committee, and past chairman of the branch, and coordinator of this program, CA Godavarthi Srinivas Rao, and my fellow members, very good evening to one and all. I welcome you all for the last day of 5 days virtual refresher course on 360 degrees of annual report organized by Corporate Laws and Corporate Governance Committee of ICA, hosted by Vijayawada branch. Our today's topic is accounting standards applicable to small and medium companies. Yesterday we have covered some of the accounting standards, and today's session will be focusing mainly on AS1, AS2, AS3, AS4, AS5, and AS7, and AS9, and AS10, and AS11. Our today's speaker, CS Jagdishan sir, is with us to explain you about what is the director's responsibility in compliance of the above standards, and auditor's role and responsibility and disclosure requirements when there is non-compliance. I request you all to have active participation and get benefited out of the session. Thank you, Ananda.
Yeah, thank you, ma'am, for your welcome address. And now I request our past chairman of the branch and our CPE committee chair, member of the convener of the Vijayawada branch, a few words about the seminar, sir.
Sir, good evening, one and all. Thank you, sir. Thank you very much. At the outset, I would like to offer only one thing, because we have caused a lot of difficulty to the Jagdishan sir. Initially, he is Mohan Lavi sir asked to place it on 27th, and he has okayed on 26th. That's why that 1 to 11 has given to sir, and 15 to other part has given to Mohan Lavi sir. Later, Mohan Lavi sir asked that you would like to prepone the things, but sir greatly graciously accepted the today's role, and that's why the accounting standards are not in a chronological order. Yesterday we are taken up from 15 through 20, 13 to 29, and today we are taking up 1 to 11. Sir, thank you very much for gracing the things and accepting our invitation. Really, it's going to be helpful for all our members. Thank you, and over to you, sir.
Thank you, GSS sir. Now it's the time to introduce our resource person of Jagdishan sir. I feel it's great privilege to introduce Jagdishan Garu to our Vijayawada fraternity members, and all our India members are also joined. And SK Jagdishan sir is a chartered accountant for around 10 years of experience in the area of audit department of large audit firms, and he is practicing CA for the last 4 years, advising and assisting clients in in-days transactions and internal audits. He has gained in-depth and extensive experience in statutory audits, international gap and gap audits or reviews of listed and large multinational companies in automotive, industrial, and IT and ITES sector. He has taken various firm-level technical training sessions on accounting, auditing, and corporate laws during his tenure with the BSR and Co. LLP. He has handled several CPE seminars organized by the SARCFICA on India's and auditing standards, and various brands also has attended as a CPE speaker. With this brief introduction, now I request Jagdishan sir take the session to the members of the Vijayawada branch.
Thank you, sir. Thank you for the Vijayawada branch for inviting me to give this presentation. So I hope this will be useful to all the members. As the chairman has requested, I would like to have utmost participation. The key thing is all these standards are really very simple, as we all know, and most of us are very, very familiar with these standards because we use these standards in a very, very day-to-day manner. So if you have large participation, then I would be in a position to clarify, most of your doubts. My only request is that, see, the point is these things are viewed from an accounting perspective. When I mean accounting perspective, there are a set of standards which we follow.
Sir, excuse me, sir. Jagdishan sir.
Tell me, sir. You have
Can you adjust your voice volume? Increase that volume is.
Sir, if you are comfortable, you can remove your headset, sir.
What was it?
You go with the normal microphone, sir. It will be okay because the previous experience was that.
Okay. Is it okay now?
Now
Yes,
it's better.
okay. Carry on, sir.
No issues. Okay. So the participation is very important. As I would like to have. So my slide is structured in such a way that how generally the accounting policies are disclosed in a normal SMC company, and how ICA has reviewed such things and have given reports in their FRRB reports. I have few examples or large examples given there. So that you will clearly understand how correctly we should disclose. Under the existing circumstances, when the regulatory environment is watching us to have exercised utmost professional judgment and accuracy in our reports, this will be definitely helpful. So with this small background, I am getting into the presentation. I'm sharing the screen now.
Meanwhile, increase the system volume also, sir. Then it will be better to reach the audio to all better.
This volume is still not better, sir?
Sometimes actually it is going to be low and fluctuated, sir.
Oh, I'll try. I'll try. So I don't know. Okay, fine. I'm sharing the screen, sir, for the presentation. Then we will. Okay. Is the screen visible? Okay. Now.
Perfect,
Yes, sir. Yes, sir. It is visible.
Done. So fine. So we will discuss critical standards like AS 1, 2, 9, 10 in these orders. So basically we'll understand the objectives behind the standards. And then what is our responsibility as an auditor responsibility, management responsibility. Okay, so most of these responsibility will go hand on hand. And then some of the illustrations and what are the practical issues which you might face in giving a disclosure of this type. Okay. Now, okay, so is there a chat? Okay, is there anything? Okay, now I think people are updating the membership numbers. Okay, now, great. So I have a question straight away. So do you think AS1 is simple or not? Can I see some answers on the screen? Elaborate. Okay, very good. Thank you, sir. At least one person has given an answer. Okay. Okay. Is the PPT not? Okay, sure. I'll share the PPT to Vijayawada branch. Maybe they will share to you. Okay. It is not simple. Okay, somebody is saying only 2 of them are answering. Okay, I don't know what happened. Large participation is really appreciated. Okay. I'm sure your attendance is recorded. I don't think membership number is required to be displayed in chat box. Any more answers, please? Okay, I'll go ahead. I hope the importance of the entire accounting policies is contained in this standard, basically. Okay, so what happens? This standard is actually very silent, and it does not insist a lot of things. Okay, but this is like the parent or the father of all the other accounting standards, I would say, because this standard requires you to disclose what have you done in the financial statements. Okay, and how have you measured anything. Okay, how are you planning to recognize something, and how will you plan to recognize in future. How do you plan to recognize initially at the time of incurring any item of, say, income, expenses, asset, and liabilities? Okay. Now what happens? Okay, the basic requirement of the standard is to just disclose accounting policies. Why do you have to disclose? The requirement is to state like this. Okay, the objective of the standard is to say, okay, please disclose all the accounting standards. And particularly the most important point here is we have to disclose only the significant accounting policies and not every accounting policy. Okay, what is significant, what is not significant? Okay, we have to take a materiality call and then disclose that. Okay, why these are required? And these are required because these accounting policies, if it is narrated in the financial statement, will give more meaningful comparison between financial statements of various other entities. Okay. So for example, just to give an example, AS2 has, say, FIFO method and then weighted average method. Now what happens if a company follows FIFO and its results would be different from a company which is following weighted average. Okay, and then those may not be comparable, and there ends the matter. Okay, so some companies will report profits and some companies may not report profits in that sense, basically. Okay, if these accounting policies are disclosed, the users will be in a position to read them in a very meaningful manner and compare them with a set of similar companies, with a set of industries, and all those things. Okay, so what do you mean by accounting policies? So accounting, the standard defines like this: accounting policies means a specific set of accounting principles and the method of applying those principles in preparation of the financial statements, also in terms of presenting the financial statements. Okay, it looks very simple as of now. Okay, sure, I'll be a little louder. Yeah. Okay, let us move on to the next one. So what does the standard say? The standard says, so I have put this as the responsibility of managers and management and the auditors. Okay, so primarily, so who has to ensure all these things? AS1 or any standard has to be first analyzed and adopted by the management. Okay, there is no requirement for the auditor to adopt these things. Okay, we are auditors and we have to clearly verify whether the adoption of accounting policy is appropriate, number one, whether it is being consistently used, and and whether it is correct, okay, more or less. Now, what are the fundamental things that we will look at? The fundamental things the standard says is, these are the fundamental assumptions as per the standard, whether the entity is going concern. Going concern is very simple. We are assuming that the company is continuing its operation for a foreseeable period. Foreseeable period is defined as, say, next 12 months, which means that the company is not expecting to have any problem to close down significant operations in the next 12 months. That's very simple. Okay. But equally, it is not simple in the present scenario or in the last 1 or 2 years. And then it is accrual. Okay. And the second point of accounting assumption is accrual based. And the third is consistency. Okay. So I'm not elaborating some of these things because these are all very, very basic in nature. And we have been following it very, very sensibly. And I don't think much elaboration is required. If you need any doubts, please put that in the chat box. We will clarify it little later. Okay. Now let us go back to the second point. If these fundamental accounting assumptions are not followed, okay, or if there is a doubt, then what we have to do? We have to disclose. Okay. The best example is going concern. Okay. Going concern, if there is a material uncertainty, if there is a significant loss, okay, and if there is a negative working capital, negative shareholders funds or net worth, we will have to say how the management is having its plan to continue its operations, right? Okay, management would have to demonstrate with such situation in the form of, let's say, future business plan. Okay, they got an order, something like that has to be given by the management, and those things shall be disclosed in the financial statements. Okay, now COVID is a significant event. Okay, now what has happened at the time of COVID is that so we have big uncertainty in terms of business, in terms of normalcy. Okay, now what has happened? And that has resulted in a going concern situation for a lot of companies. Now they have evaluated in the light of the restrictions placed by the government, and then subsequent ease of such restrictions and how they have adopted to such situations, and how the business has improved, and whether it is profitably being running, and with a lot of concepts like work from home, and how they are coping up with the new developments. Okay, these all will have an impact on going concern. Okay, and it depends on industry to industry, and we have to specifically see those things. Okay, now so I completely understand all these standards. Okay, what we are covering today are to be disclosed mandatorily by SMCs, level 1, level 2, level 3, all companies. Okay, I don't see any or very, very few disclosure exemptions are there. That's all. But all the measurement criteria, disclosure criteria are applicable for SMCs and level 1, 2, 3 entities. Okay, we will cover those things. Now there are no exemptions, so I have not given any comparison anywhere stating that okay, it is not applicable to SMC, it is applicable to SMC, something like that. Okay, now disclosure. Okay, disclosure here. So where do you disclose these accounting policies? The standard says you disclose anywhere, but you disclose in one place. You put all those accounting policies in one place so that it is clearly be read by the user. That's all. Okay. Now, if there is a change in accounting policy, then the standard requires you to disclose the material effect of the change. Okay. How much amount has to be disclosed, and it has to be disclosed only when it is ascertainable. If it is not ascertainable, kindly provide the reasons of why that is not being disclosed. That's all. Okay. Now these all are with respect to disclosure of accounting policies. What are the fundamental accounting assumptions and that. Okay. How do you select appropriate accounting policies? Selection of appropriate accounting policies will be dependent on 3 criteria. Okay. One is prudence, second one is substance over form, and third one is materiality. Okay. So these are very basic concepts. Let us not cover. Okay. And then if you have any doubts, please let me know. Now, all significant accounting policies adopted in preparation of presentation of financial statements should be disclosed in the financial statements in one place. Okay. Kindly remember this in mind, because we generally get into a statutory requirement into accounting policy. Okay. There may be a confusion. So what happens generally, say inventory, assuming, okay, I've seen companies inventories, valuation method, they have disclosed below the note on inventories. Okay, that is not appropriate. You have to disclose in a separate note, which should be headed as significant accounting policies. And under that, we have to write what is the accounting policy adopted by the company and what are the method of valuation and how they will measure those inventory. These should be critically be there. Okay. Now, this is the requirement. This is the responsibility. Okay, whose responsibility is to verify these things? Management should first ensure that they have done all these things, and then they should select accounting policies based on the criteria specified, which is prudence, substance over form, and materiality. And auditor should ensure that the management has done their role correctly or done their assessment correctly, to put it in a right way. Okay, so this is all very simple now. Okay, this is a set of illustrative list that we have just collated for you. This is standard based, and then and it is based on something. Okay, so basis of preparation, it is based on Companies Act, and we followed say ICAI specific standards or Companies Act specific standards. Okay, and the company is a level 1 company, level 2 company, or an SMC, non-SMC. Okay, so here, okay, so we have not covered SMC, non-SMC. So there are a set of requirements there. So point is, companies set up different SMCs, and then there are some exemption criteria for SMCs. Okay, under the basis of preparation, we should specifically mention that the company is an SMC, and accordingly it has availed certain relaxations or exemptions provided in disclosure of accounting policies. Okay, this statement has to be mandatorily mentioned in the basis of preparation. Okay, now if it is not mentioned, okay, what will happen? The user might think that if it is not mentioned, it is assumed that it is a company is complying with all the accounting standards. Okay, the user might be having a wrong information. Now, so this is a requirement under the company's accounting standards rules. Okay, now this is very important. Okay, a lot of us may or may not have disclosed. Okay, if you are not disclosing, then kindly go through those requirements, and then the wordings are very simple. These are two to three lines, and then so because this session is mainly targeted for us who are covering small and medium-sized companies. Okay, now, okay, this is one thing which is important. All others, if you note, okay, the use of estimates, okay, which is covered at AS4, property, plant, and equipment, AS10, AS26, and then depreciation and amortization, okay, which is covered now in AS10, borrowing cost, AS16, okay, borrowing cost can be disclosed separately, or we can disclose along with property, plant, and equipment, inventory, okay, and then foreign currency translation. How if there are, so this is very critical. If there are foreign currency operations or transactions, then you will have this a significant accounting policy. If it is not there, then we need not disclose. Okay, revenue recognition is critical. Other operating income, employee benefits is one thing. Current tax, deferred tax, leases, cash flow. So kindly go through those standards, and then we will have to disclose each and every accounting policy. If say government grants are not applicable, we are not going to disclose. Okay. Provisions, contingent liabilities. These are the illustrative set of. These are primarily covered by the list of standard which is there, and then based on it we have summarized. Say for example, foreign currency translation. If it is applicable, please provide your accounting policy. If it is not applicable, you need not disclose. Very simple. Okay. Now, so let us go back. Okay. So before we get into, so kindly remember these things. Okay. And generally what used to happen is that there will be a one-liner statement. Okay. Like this. Okay. Let us read this on a very sincere way. Okay. What happens in some of the annual reports? Okay. These are the statements which is made. Impairment losses on fixed assets are recognized in accordance with the AS 28. Okay. Issued by ICAI and charged to statement of profit and loss. Intangible assets are recognized and accounted at cost in accordance with AS 26 issued by ICAI. Deferred tax has been provided for in accordance with AS 22. So do you really think these accounting policies are appropriately disclosed in the financial statement? Can I get some answers, please? No. Very good. Thank you so much, sir. Thank you, ma'am. Thank you, sir. Okay, good. See, it is obviously no, right? So we are getting a lot of no here. Okay, why do you think it is no? Okay, now I'll give you the answers for this. Wordings can be changed. Okay, wordings can be changed. Okay, instead of change, it has to be elaborated. Okay, number one, that's what the standard requires. Okay, and that's why AS1 is absolutely silent and it tries such does not convey the absolutely good. Thank you, Mr. Azim Roy, and it is correct. Okay, fine. So the answer is very simple, and this is an FRRB observation, and it is quite simple. See, these policies are given only to give an understanding that yes, we have the company has adopted something. Okay, but accounting policy should have more explicit statement so that the readers will be able to understand the financial statement. Okay, so that's very important actually. Now, so now the stated accounting policies are not in requirements AS1 because it is not elaborate. And then the references, the most important point I would like to clarify here. See, ICAI specific notified ICAI accounting standards are taken by the government, and they have included this as part of company's accounting standard rules. So now the issuing authority or the authority for issuing the accounting standard is MCA, okay, and not ICAI for companies. Okay, ICAI accounting standard has to be followed only for level 1, level 2, level 3 entities, say a partnership firm, okay, LLP, something like that, and not companies. Companies should 100% follow companies accounting standards rules. Okay, so here what has happened, everywhere they have mentioned as ICAI. So ICAI, there is no way that in basis of preparation there should be a clear statement stating that the preparation, the financial statements have been prepared by adopting the accounting standards specified in companies accounting standards rules 2006. Okay, this statement has to be there, and then the subsequent accounting policy should have. There are other pronouncements. Yes, we are supposed to follow other pronouncements. So those are like guidance note, ESU opinions, and all those things. Okay, we can have mention of those things as other pronouncements of ICAI, but accounting standard is clearly given by companies, MCA, Ministry of Corporate Affairs, and not by ICAI. Okay, so this reference to ICAI should not be given in case of a company, but it is absolutely be mandatory for a level 1, level 2 entity other than companies. Okay. So this is my thing. So these policies are not elaborate enough to give how they are measured, okay, how it is being done. For example, impairment losses. Impairment is recognized, but how the company will determine its value in use, okay, what is the methodology followed, how it has compared with the carrying amount, and where it has been recognized, it is not, it is absent. Okay. Yeah. Now let us go back to the next one. So these are some of the examples where, okay, the answer is actually be no only. Okay, I'm telling you. See, the point is here, the turnover. This is a revenue recognition policy. Turnover includes sale of services. Yes, we know. Obviously, turnover will include these things. Okay, now sales are net of these things. Very good. Okay, income from sale. So, do you think any matters given for revenue recognition is given here? Okay, so kindly read them very, very carefully. It does not give the matter of revenue recognition. Okay, so man, how are we recognizing? What is the point at which the risk and rewards are being transferred? What is the point at which the collectability is ensured? Okay, it is not there. Okay, the moment it is not there, okay, then it is not considered to be appropriately disclosed. Okay, I have this answer. It is simply stating that revenue has been recognized. There is no statement of the point of time. Okay, now, so at least when the risk and rewards is transferred, and when do we have to recognize revenue? This is not available right now. Now, so timing of recognition is absolutely important. Okay, so without knowing this, the user will not be able to understand, okay, how the revenues are being recognized by the company. Okay, So this is not in accordance with AS1, which is paragraph 24, right? The statements has to be very, very clear. Okay. So we will go through a set of annual reports which is prepared by large companies, and we will look at how detailed those annual returns are in respect of accounting policies. Okay, little later. Okay, so those are the kind of elaborate statements that which we have to make for all companies, even for partnership firms nowadays, even for tax audits. I think there is an illustration which is published by WRC or by many branches of ICAI, where all the accounting standards, policies are very, very elaborate in nature. Otherwise, we will not be in a position to say that we have done a set of audit procedure, and then there's a clear independence between the management's role in terms of assessing the valuation criteria or the measurement criteria of various accounting principles, accounting financial statement captions, and then our verification should be different, completely different from the management's role. Okay, yeah. Now, clear. Now we'll go to the next question. See, there is a statement, all income, this is an accounting policy disclosed somewhere, all income and expenditure items having a material bearing on the financial statement recognized on accrual basis, right? So this statement is assumed by the standard itself, and it says, yes, you are recognizing an accrual basis. You need not disclose when you do accrual basis accounting. Okay. Now, what is the point in explicitly stating again, expenses and income are accounted for on an accrual basis? Different. There's no use. Okay, income and expenditure recognized on accrual basis, except benefits on special import license premium. Okay, why? No idea. Okay. So do you think this is sufficient? Okay. See, institute says that okay, there has to be risk and rewards when it has been transferred. It is not stated. So just by writing this one statement, okay, do we think really that we have mentioned all the accounting policies? No. Okay, the answer is a straight no. So the revenue recognition policy should clearly state how and at what time that we recognize revenue. Okay, we will see revenue recognition related principles a little later. Okay. So in the sense that, okay, a simple statement like this is absolutely prohibited at least in my words, it is absolutely prohibited. Okay, because it doesn't explain anything. Okay, so accounting policies, say for example, it should run at least 3 to 4 pages in my view. Okay, so that it will really explain the transaction which the company has undertaken, and there are a lot more other things also. Yeah, done. Now, so we'll move on. So these are some of very dangerous statements. Okay, so never ever think that these statements are fine and then yes, we are done with. No, that's not the thing. These statement is absolutely not required. For example, the second one, expenses and income are accounted for on an accrual basis. Okay, it is not acceptable. It is not acceptable because income is not given, timing is not given, expenses, accrual is assumed. So we need not disclose. Very simple. This is the fundamental assumptions, right? So why do you have to disclose accrual as a policy? Accrual is assumed. So when something is assumed, we need not explicitly state that assumption in the financial statement. When you have doubt, when you did not follow something, then we may have to disclose, and the impact on the financial statement has also to be disclosed there. Okay, fine. Please keep this in mind so that it will be useful. Yeah, the statement on accrual basis is also okay. So okay, here it's an interesting point. So there is a set of financial statements. Okay, in one place they have disclosed significant accounting policies. Under significant accounting policies, the company has disclosed investments, other income, foreign currency, and these items in one place. And other accounting policies related to deferred tax, inventory valuation, they have given in the respective notes. For example, below inventory, they have given how they have valued inventory, and below fixed assets and depreciation, they have given their policy. Okay. Now, whether this presentation is correct as per AS1. Okay, no answers. Okay, good. Thank you. Thank you so much. So the answer is no. So we have discussed this, and in the slide, it is very clearly mentioned that accounting policies, okay, have been scattered at various places in this financial statements, and the standard requires us to disclose these things in one place, okay, whichever note, and preferably immediately after cash flow statement we should disclose, and we have a policy, or we have a practice of disclosing accounting policies at the end. Okay, so that is not correct actually. So a lot of companies have already been disclosing as, say, cash flow, balance sheet, P&L, cash flow, then accounting policies, then notes for balance sheet and notes for P&L. Okay, so this is how. So these are common errors which happens from an accounting. So that is why I said AS1 appears to be simple. So many of us have to follow this. Otherwise, it will be difficult for us to justify how we have tested, how we have laid on the measurement, disclosure, whether the disclosure criteria has been met, and how their management is measuring, and how they are recognizing. So we are not having any basis for them to. The basis comes from the accounting policies in the financial statement. If the basis is not there, okay, and it is not clearly been stated, okay, the financial statement is not prepared in accordance with accounting standards. If AS1 is not followed, financial statement is subject to lot of scrutiny. That's all. Okay. Now we'll move to AS2 now. So we have some list of yes, thanks Azim, right? So been very participative. Okay, AS2 now. AS2 is also very simple. AS2 is also very simple, but the only point is, I think, without, I think, the coverage or the experience which a lot of us have to audit this inventory is absolutely extensive, and then we have a huge experience in auditing inventories. Okay, now, so what does the standard say? The standard says, yeah, to determine the value of inventories, okay, and then to ascertain the cost of inventories, and to lay criteria how to write down if there's a situation of reduction in prices which result in NRV testing. Okay, so these are the things. These are purely principle based. The standard is straight, and we have to follow. There is no exemption in saying that no, we have taken an exemption, we cannot follow. These standards are very principle driven. It has to be followed, and that is why it says it is accounting principle. Okay, we have to follow these things. So what are the inventories? The inventories. So what do you call as inventories? Okay, so this is a more interesting definition. Assets that are held for sale in the ordinary course of business, in the process of production for such sale, and in the form of materials or supplies to be consumed in the production process or in rendering services. Only these things, okay, when you hold something for, so first is trading, and second is work in progress, and third one is materials. Okay, to simply summarize and say, what is a net realizable value? It is nothing but an estimated selling price in an ordinary business scenario minus estimated cost of completion and selling cost, okay, and sales rated cost of that particular item. That's all. Okay, remember these two things, and then we will discuss one by one. Now, okay, what is cost of inventories? Cost of inventories will comprise of cost of purchases, cost of conversion, and then any other cost incurred in bringing the inventory to the existing location and condition. Okay, very simple. Now, what is cost of purchase? We all know purchase price plus or minus duties and taxes, and that plus or minus dependent on if it is recoverable, then we will not include. If it is not recoverable, that becomes the cost of purchase. Freight inwards, okay, other expenses directly attributable to the acquisition. Okay, So here is where the judgment comes into play. Okay, we will discuss this in detail when we do fixed assets, and then it will definitely exclude trade discounts, rebate, duties and drawbacks, and other similar items. Okay, so there are set of practices where trade discounts are disclosed as part of other income. That is wrong. Rebates, okay, duty drawback, if it is given separately, okay, then it has to be disclosed other income. Otherwise, it'll be forming part of the purchase price itself. Okay, we have to be very careful in terms of timing at which we will get that. Okay, so here the header comes into play. What is our responsibility? What is management responsibility? So primary responsibility falls on the management to see whether they have determined the purchase prices correctly. Okay, now, and our responsibility to verify whether those are absolutely be correct in terms of reporting those numbers in the financial statements. Okay, no. Okay, what is cost of conversion? There are two things. One is labor, the other one is production overheads. Labor directly attributable, it will be allocated to the units of production. Production overhead divided into two, variable, fixed. Variable is taken at actual per unit of production. Fixed is based on normal production capacity, and then the rate will change. Okay, now okay, other costs. So other costs are nothing but the cost incurred for bringing to the existing location. Okay, so we will have some examples so that inventory is slightly interesting. So because we have a lot of, the management would like to take everything to inventory because they would not like to report losses when they don't sell the product. Okay, so we have to be very, very careful in this scenario. Now, these are the basic principles. Let us not worry about these basic principles much. Now we will so valuation criteria. We have cost and estimated net realizable value. Whichever is lower will become the value of inventory. Very simple. Now, so all these simple matters will become problematic matters when you have a practical scenario. Okay, right? I'll explain a lot of these things based on the examples we have, and our experience also will be shared here. Now, what is the valuation methodology? Valuation methodology is if the items are interchangeable, and then we will go for FIFO or weighted average. If the items are not interchangeable, then what will happen? We'll have to do specific identification method only. Okay, if it is not interchangeable, then specific identification. If it is interchangeable, then we will go for FIFO or weighted average. Very important. Now, NRV determination. So we should get the most reliable evidence. Okay, that at the time of balance sheet, that is more important. Okay, now, okay, these estimates take into consideration fluctuation. So what will happen? So there are two things actually. So as at the balance sheet date, subsequent to the balance sheet date, we will have to as at the balance sheet if there is no problem. Okay, subsequently if something is becoming absolute, then what will happen? So you will not be able to sell the product which is lying as at the balance sheet. So what will happen? The provision NRV testing should be done for the closing inventories also, right? No, there is a second criteria. Generally, NRV, what will happen? There will be a cost, there will be an estimated selling price. If the estimated selling price is less than the cost is cost of conversion and other cost, we will reduce to the cost. If it is less than the material, suppose the example is if there is a material cost, say 100 rupees, and you are expected to sell at 90, only 90, then what will happen? You are holding the materials in the inventory. Then what will happen? All the inventories which are required to produce this item will be reduced to 90. Okay, so we should not confuse as if NRV is applicable only for fixed finished goods. NRV is applicable even for raw materials. Okay, because the raw materials are used for the purpose of producing one item of finished goods, those finished goods should not go below the cost of raw materials. If it goes, then the cost would also be reduced, which means the raw material will also be measured at NRV. Okay, so if you have any doubts, please let me know so that we will discuss here itself. This is very important. So many cases, for example, if there is a car, the car, all the raw materials put together, say cost say 2 lakh rupees, and the car was selling at 2.1 lakh in the first week of April. Then there is a sudden discount offered on April 15th, and then it is continued for say 2-3 months. Then what will happen? So it's say 15% something. Then the car would have been selling at say 1.8 lakhs or 1.9 lakhs. Then all the inventories with respect to finished goods will anyway naturally reduce at NRV. Okay, now what will happen to the raw materials which are held with the organization to produce the car? Now those also should be reduced to raw materials. Okay, those cost of raw materials should be reduced to the NRV, right? This is very critical. I'm not sure to what extent are we doing this, and then how critical it is in your scenario, because we are talking at a SMC level. Think it is important because in terms of COVID, if the organization is operating in say specific 1 or 2 locations, this will have a critical impact on your organizations. Okay, if you don't watch, you would have missed. Based on materiality, you will be saved, but if it is material, then we will be caught. That's all. Okay, so kindly exercise a lot of judgment in this area. You just compare and see. Okay, but my only thing is, okay, a lot of us may or may not be doing inventory valuation. Okay, there are certain illustrative examples here. Well, let us see those things also. Okay, now I have a set of case studies. Kindly participate, please. Okay, bonus relating to related to sale of inventory. So now what happens? There is a car dealer who will receive bonus from the car manufacturer on achieving sales target. This is very common. So what happens to the sales related bonus? Will you reduce such bonus from the sale of inventory? Okay, this is the question. Do you have any answers? Can I see some answers, please? No. Okay, then no. Okay, thank you. So this is straight away. So thanks for the answers. Yeah, so right. So this bonus is actually a contingent asset. Depending on a lot of other criteria the company may have given. We have achieved the sales target, and we will recognize only as an income at the point in which it is recognized. So the collectibility is a primary criteria, and we'll have to recognize this as income at the time that it becomes certain that the company will collect this money. Okay, now. So inventory. So being inventory, so we said it is something which is held for the purposes of sale. Now, this is very interesting. So the company is there is a development land, which means it is a real estate property. Okay, I have a plot of land, say 5 acres or 50 acres. Okay, and the land value will increase only by building an access road from the main road to the site. The access road will not be owned by the company because it will be owned by the, say, corporation or municipality or whichever it may be. Now, can you capitalize this cost to the cost of building? Sorry, Mr. Kishore. Any answers? Yes. Somebody is saying yes. Supposed to be accumulated and recovered. receive answers. So, okay, so the point is, it should be very clear that the company will gain economic benefits. Okay, so what is the point? Because the access road will be laid, okay, and then it will increase the value of say that plot of land, and if there is a future economic benefit, and then it is capitalized. Okay, if it is not, say for example, if there is already a road, you are just developing it with some extended say 100 feet to 50 feet or something, 50 feet, 100 feet, then what will happen? So it is whatever you do is may not increase the value. If it is not, if the company is not able to establish that it will gain economic benefits, then it is not capitalized. Okay, otherwise it will be capitalized, right? Now we'll move on to the next question. Now, storage cost. Okay, so the storage cost will be included. Yes, this is included. And now fertilizer. This is very interesting. Now, so the company is trading in fertilizers. It buys fertilizers in bulk quantities. It buys in ships, and then it will be stored near the port. Okay, seaport itself. Now it is based on the local market. They will move to the third-party warehouse till it is sold. So what will happen to the storage cost? Whether it can be capitalized. Saying yes. The answer yes very much is for fertilizers, cost of inventory. Mr. Raidu saying thank you. So actually it is not. Actually it is not. Okay. See, this is primarily because the inventory is done. Okay. It has come to its existing location and condition. Okay. So there is that's where we call it as primary, secondary. Okay. So this is all primary location, and then and you are waiting for the third party to give the order, and then only you'll move. Okay, until then it is not sold, so it is not eligible for cap. When I mean capitalization here, it is inventorization. Okay, no, it is not eligible. Fertilizer it is not eligible, and in the other example, capitalization is possible because it is naturally required for the quality of the product, and then okay, so it is eligible. Otherwise, it is not eligible. Yeah. So cost of editing and translation cost. There is a publisher. Okay, he's incurring cost of editing, translating, and collection of data. Can the editing and translation cost be included in cost of inventory? Yes, sir. Cost of inventory will not go up. Yes. Answer is yes for travel guide. Yes. So these are directly attributable cost incurred for the purpose of preparation of the travel guides, and accordingly, it is capitalizable. Now we are moving to the accounting policy, presentation of accounting policy. Okay, accounting policies of inventories. Very important. This is very, very common. Okay, I'm sorry. The stock of paper, books, and magazines is as certified by the management. Acceptable, not acceptable. I don't want yes or no. Please, sir. No, I don't want no. Whether it is acceptable, not acceptable. Thank you so much, sir. Thank you so much. Not acceptable. Not. Okay, only not acceptable. Very good. To not acceptable to us or to the management? Okay, I don't know. Should have been clear. Okay, I'm sorry. So it is clearly not acceptable. Okay, now we'll move on to the next one. Raw materials, consumable, source and spares are valued lower of cost and it's are certified by the management. Okay, the statement is very, very dangerous. Without as certified by the management, it is okay. Not acceptable to us, auditor. Very good. Thank you so much. Okay. So finish goes. There is no way that we can have such things in place. Okay, this is all wrong. Okay, there is no way that. So the expectations outside world will have is auditor is supposed to physically verify this inventory at least on a sample basis. Number one. Number two, he should have gone through the evidences provided by the management to say the valuation is correct. Okay, this is the external expectation. Now, what is Institute's guidance note saying? Institute guidance note saying that if the auditor is relying on the management certificate without carrying out appropriate audit procedures, okay, then it is not acceptable. Okay, so this is a statement. It is as per the guidance note. Guidance note says that, okay, you have simply related, you have not done any procedure. If you have made the statement, auditor has not done any procedure, and then simply he is relied on management certificate. Okay, there are specific cases where we have a wrong notion stating that we got management representation. This will be sufficient. This is not sufficient. Okay, this is not sufficient, and then whatever the issues will arise, we have to face them. Okay, so auditor's role here should be that, okay, we should advise the clients to omit the expression as taken, valued, and certified by the director, management, nothing. Okay, we have to collect evidences of stating invoices, seeing their values, how NRV is issued, how NRV management will certify. Management will never certify NRV. No, they won't say that the price has come down, nothing like that. Okay, so they want profits, and the profit will result into a loan, profit will result into an appreciation in share price, so that they can move out of the organization. These are the intention generally. Okay, how are we going to cover ourselves is very, very important. Okay, now, so this statement is clearly not acceptable to any of us, and then so this should be completely avoided. Yeah, so yeah, this is correct. So Joshi, I don't know. So this disclosure is by management and not an audit report. I accept, but as certified by the management, okay, this is not acceptable. That's all. Okay, nowhere the management certifies in notes to accounts. Okay, it is their statement that we all know. Yeah. So fine. So here there is another scenario. So accounting policy, short-term. So there is another scenario. Short-term provisions include provision towards old inventory. Amount is very significant. But what happens in this case? The provision is disclosed gross. So inventory is disclosed separately. Provision for inventory is disclosed separately. This is not in line with the requirements of AS2. So this is not acceptable. Provision is net of inventory always. It is net of inventory always. So then only it is fair presentation. Otherwise, it is not fair presentation. Okay, please. Now, so import of materials accounted on receipt thereof at the factory. So this is also not correct. So these, I will tell you, these are not accounting policies. Okay, these are all mere statements or mere inability statements. Okay, that is not correct. So inability statement cannot become an accounting policy. Why? So when you know that there is an import, then what will happen? You will get an invoice. Then in that invoice should be accounted as a liability, and the materials should be accounted as materials in transit. Very simple. And we know the price, and we know the ship of loading, and we know when it is going to reach, and we know who is going to take the risk. And the only point here we have to consider is INCO terms. Okay, please consider for INCO terms. And INCO terms will define until what point in time the risk and rewards will be borne by the seller. Until what point in time risk and reward by the buyer. If it is borne by the buyer, who is an Indian company, then we will account for materials in transit. If the risk and rewards are to be borne by them until it is delivered in, say, a port in India, then what will happen? We will not account. We will wait until it reaches the port of destination. Simple. So that's the only thing which is silent here. Otherwise, generally, we let account the liability and then account the materials in transit upfront. Simple. This statement of import of materials is accounted on receipt thereof at the factory. So there is a port, and then we will arrange for transportation from the port to here. And then now in GST, we'll also raise e-way bill. And do you mean to say that the management is stating that they don't have any control over those materials until it reaches the factory? Okay, which is not acceptable because it is not reported in the financial statements. In two things: one, asset is not recognized, liability is not disclosed. Okay, both are problematic, not acceptable. Are we clear here? Any doubts so far? We have a lot of time. Any doubts in inventory? So, yeah. Check. Okay. So I will separately display the set of accounting policies for inventory. We will read through, and then we can understand how accounting policies are written for inventory. Okay, no worries. That's fine. Now we'll move on to say revenue recognition. So the only point which I'm going to tell you is we would have done procedures, we would have done, we would have ensured all the transaction, we would have ensured all the assertions, management assertions in each of the financial statement captions. But the only but is accounting policy should also say the same thing. Okay, plus representation, plus our work paper. If all these three things, any reporting requirement for livestock inventory. So livestock, I think it is separately covered in agricultural related standards, sir, and I don't think there is any reporting requirement which I am aware of. I'm sorry. Okay. Okay, now we'll move on to the revenue recognition. Okay, we'll move on to the revenue recognition. This is again a very loosely seen accounting standard, but it is very important to follow these standards. Very, very important to test these standards. Okay, so we'll have to understand the intentions of the management first. What in inventory they would like to overstate inventories. Number one, overstatement is not possible now. Why it is not possible? Because we are supposed to report on a quarterly basis whether the statement submitted by the management is in line with books of accounts. Number one. So there itself we are gone. Okay. So management is finding it very difficult to report nowadays on excess inventory because we are supposed to test on a quarterly basis. Please understand the repercussions of reporting on a positive note there, and at the same time, the management should also see that somebody is reporting. Somebody is what? Your own auditor. We will have to report there. Now, in terms of revenue recognition, they always would like to have an upfront revenue recognition, which is generally not possible. Okay, they collect the money, they recognize. That is not possible. You have to satisfy a set of conditions, and if the conditions are met, please recognize. Okay. Now, we'll move on to revenue recognition as a standard. Very simple. Standard says ordinary course of business. If there is ordinary course of business, sale of product goods, rendering of services, then the standard is applicable. Okay. The standard is defining revenue as gross inflow in cash, receivables, or other consideration arising in the ordinary activities of the enterprise. Okay. Then it is revenue. If it is not arising from ordinary activities, then it should be reported elsewhere. Okay, as other income, other operating income, something like that. Okay, otherwise it is not considered as revenue. So revenue is measured by charges made to customers or clients for goods, separate services rendered to them, and then by the charges or rewards arising from use of resources by them. Okay, so it is based on charges. Clearly, it is based on charges, which means an actual price or consideration being collected or collectible from the customers or clients. Okay. But in an agency relationship, revenue is the amount of commission and not inflow of cash or receivables or other consideration. Are we clear here? Yes. Okay. So this is the basic definition, and it is all defined in para 4, and we have to bear this in mind. Okay. It is gross inflow in cash. This gross inflow. Okay. After GST, it has lost its context because we used to disclose excise duty as gross. Okay, and reduce it, and then we report a net revenue, right? So otherwise there is no purpose here after GST. Now let us move on to the next concept. So for sale of goods, what are the conditions to be satisfied? First, sale of goods, the condition to be satisfied are this: 1, there should be a transfer of property in goods. 2, there should be a delivery, which means the significant risk and rewards of ownership have been transferred. And 3, no significant uncertainty exists with respect to consideration that will be derived from sale of goods. Okay. So these three conditions has to be satisfied. Okay. The only question over here is only question. So the first 2 points appear to be similar. Okay, that is, those are not similar. One is talking about delivery, the other is talking about transfer of ownership. Okay, so how you hand over. Okay, these two things are different. Okay, please bear this in mind. There is a transfer of title, and then there is a significant transfer of risk and rewards. And these things have to be mentioned in the accounting policy. Otherwise, there is no use. Okay. Now, rendering of services, there are two types. One is completed service contract, one is proportionate contract method. The completion is at single time, and then if it is billable, and then you can recognize revenue. If it is proportionate complete method, then we will have to recognize revenue based on performance stages, which is called POC. Okay, which is percentage of completion method. We will recognize revenue in the financial statements. Now, what happens if the entity's resources are used by others? Then we will have interest. Interest will be recognized on time proportionate basis, royalty on an accrual basis. There should be an agreement, and based on that agreement, we will accrue the amount. Dividend based on when the right to. So this is right to receive payment is established. Okay. Now. Okay, now AS9, we will have some 1 or 2 case studies to understand how the timing is tested. There is a sale of ticket now, and there is advertisement revenue. So these two are different concepts. Okay, there is a sale of, say, IPL ticket is sold today for final match. Can they recognize revenue? And similarly, advertisement. No answers. Thank you, Mr. Bharat. No. Okay. What about advertisement revenue? Yes. It is purely on completion. Thank you. 1 second. So it is purely on completion. Okay. So what happens? There might be a substantial time there between sale of tickets and actual event. Okay. And then such revenue cannot be considered to have been earned until and unless the event has taken place. Until the event has taken place, there is no recognition of revenue. Only when the event has taken place, then we will recognize revenue. Now, what happens in case of an advertisement? Advertisement, yes, the slots are fixed for an IPL match and realizations are confirmed. Now, what will happen? Here also, the event has to happen, and then only there can be a situation for recognizing revenue. Okay. Now, we'll move on to the next example. Now, see, there is an online education services. There is a subscription fees which has been charged. What should be the timing of? So, see, for example, these examples are upfront in nature. Okay, can you recognize revenue here? And what is the timing of recognition of revenue? A simple yes or no may not be sufficient. Okay, I don't know if you have seen the answer. It will be sufficient. Can I get some answers, please? Okay, thank you, Mr. Jayachandran, sir. Okay. Period wise for the completion. What about codes can be recognized based on period, even if the goods are not on the rate of closure? No. We'll understand that concept later in detail. Okay, sir. So first I'll give this answer. So revenue is deferred first, and then subscription fees is recognized over the period when the services are rendered. Okay, it is over the period of time. Okay, say for example, if nowadays upfront fees is charged. Okay, upfront fees is charged. Say 6 months, 40,000 rupees. Okay, then divide 6 months. 40,000 divided by 6. Recognize over a period of time, proportionate. Yes. So there is a question about cold storage plan by Mr. Satish Kumar. Okay, now I'll take that. What about a cold storage plan? Can we recognize based on period even if goods are not delivered as on the date of closure? Okay, I don't think the question is clear, but if my understanding is correct, if there are goods stored, okay, now you will recognize based on, so this is all like royalties, right? This will be based on the agreement, contracted rates, where was storage. So if we had agreed for say 100 per square feet, and we will recognize revenue based on those 100. Okay. Not sure about the question. Okay. So fine. Yes. So how do you distinguish between registration fees for course? Okay. Yeah. So it depends actually. So when there is a not, so that is why they smartly use this word non-refundable, and then tuition fees, and then book fees. Okay, these are some of the ways in which they can upfront the revenue. Okay, so book fees, school fees, uniform fees, bus fees, all those things. Okay, these bus fees, tuition fees, all those things should be recognized over a period of time. So books are distributed in advance. There is no way that they will be able to take. So upfront. Now registration fees, application fees, it is irreversible. There is no way that you are going to refund. So it is upfront. Whereas tuition fees, the delivery, the performance of teaching happens over a period of time. The performance of transportation services happens over the period of time. And accordingly, it has to be recognized over a period of time. Okay. So this concept is very clear in IFRS or Ind AS scenario. Okay. Unfortunately, in our scenario, we are having this revenue recognition as a concept. There is a step. The performance is over a period of time, so it is over a period of time, right? So timing in which the performance is delivered, so we'll recognize in accordance with those performances. That's all. Okay. Now, fine. The next most important thing. This is accounting policy. Okay. Accounting policy for revenue recognition states like this. Revenue or income is recognized when no significant uncertainty as to measurability or collectability exists. Super, very good. Revenue, income, okay, this again, cost, expenditure are accounted for on accrual basis. Okay, so this is all we covered. Sales are accounted for on dispatch of products. Okay, any answers for this? Are you okay with this way of writing and disclosing an accounting policy? Thank you, Jaitan. Very conservative. Thank you, sir. Okay. Is there any way that why are we thinking it is no? Can I get more answers, please? Risk and reward on. Very good. I think he has got it. Customer may not have ordered for it. No, that's not the answer. I think Kaluram has given the answer here. See, there is no way that they're disclosing the risk and reward. What is the timing in which the risk and significant risk and rewards are being transferred to the customer? So they're very silent on whether measurability is there, collectability exists. When are they transferring the risk and when are they delivering? And it is also silent on delivery. Okay, there's no such thing. So this is not appropriate way of disclosing an accounting policy. Okay. Now yes, move on to the next one. So this is slightly interesting. The company has recognized as income the entire cost of garments destroyed by fire under other operating income. Right? There is a fire. The company has lost all its garments. Okay. Now the entire cost is recognized as income. Okay, which means there is no loss in the financial statements. Now, with regard to partially damaged truck, they sold. They have taken a net realizable value. The insurance claim is pending. Okay. Everything they have recognized. Now, what is your answer on whether it is correct, this accounting policy, or whether this way of recognizing is correct? so many questions in. Okay. How can that be disclosed if it is not acceptable? They have disclosed it is not acceptable. So that is why this session is particularly. So we should not loosely word. It is very clear. It has to be precise because and only because it is. These standards are principle based. Okay. Yes, it must be evaluated. That's okay. Whether this way of recognition is correct, this way of disclosing account. See, you should not think mainly that. Okay, I have written an accounting policy, and based on that accounting policy, management has recognized something, and you should not think that you are completely away from your responsibility. Okay, so you are also jointly responsible for the statements. So we are also signing the financial statements, right? So how can we say? No, student says it has to be accounted. Claims being received. Yes. Okay, so there's a separate. Guidance on how to recognize insurance claims. Okay, the answer is no. These such claims are not falling within the scope of AS9. Now that separate guidance by institute says that it has to be recognized only when there is no doubt on ultimate collection. Number one. Number two, it is always measurable. Okay, until the insurance company comes and makes an evaluation, okay, it is not appropriate to recognize insurance claims in books. Okay, until it is recognized, it is lost. We have to reduce the value of inventory, reduce the value of fixed assets, everything will hit the P&L. Okay, once the insurance company accepts or sanctions its order for paying some compensation, then it becomes the amount for us to recognize. Otherwise, we cannot recognize. Okay. Yes. Okay. So this is the way in which the standard has to be approached. Okay. So all the accounting policies should carry three things. One, risk and rewards transfer should be mentioned in accounting policy. Collectability, there is no doubt on collectability. Delivery. Okay. And so it should clearly specify the timing of revenue recognition. If that is clearly specified, then we will be in a position to say that the accounting policy is written with a clear term, and that will ensure that okay, revenue recognition is happening correctly. Okay, so I'm not saying whether that alone will ensure. That will have a communication that we are disclosing them correctly. Fine. Okay. We'll move on to property, plant, and equipment now. So now I have a general question. Okay, I'll give you the answer even if you don't respond. I would like to respond. Okay, if you go to a large retail store, okay, say like Lifestyle, okay, say Pantaloons, say Geo, okay, so there will be a note which says that okay, return policy. We can return say those goods purchased within a period of say 7 days. Okay, in those scenarios, do you all think that revenue can be recognized on the date of sale? So suppose I go to a store, say Reliance store, and buy a product. Okay, and the invoice will clearly say to come in 7 days and replace it. Okay, so when should the invoice be? When should we recognize that sale? Okay. Okay. So we're getting two different answers here. Okay, so 7th day, same day. Okay. Thanks. I don't know your name. Thanks. So So the point here is very, okay, slightly involving judgment or estimate over here. Okay. Thanks, Josie. Yeah, obviously. So what will happen? So the sale is done. Okay. For example, the sale is done on today. Okay. Today the product is sold and I'm taking those shirts or anything which I purchased. I take them to my home. Okay. So based on the past experience of the company will evaluate how many such items will return. Okay. They have to make a determination of an estimate. If there is a return policy, then they have to estimate. That estimate has to be provided for in books. Okay. So take the last 7 days sales, take the previous experience, get some estimates done, and based on that, make a provision for the last 7 days sales alone. This is how this what we have, that expected return for the 7 day sale can be addressed. Okay. 7 days we can provide for the same. No, we don't wait for 7 days. So for example, there are companies which declare the dividend, which should declare their results in 14 days time or 10 days time. How do you wait for 7 days? No, it is not possible. Then you are not closing your books on 31st March. You're waiting for something else. Okay, that's not possible. So what happens for the last 7 days sales? You take the sales and you take the full list of returns which is possibly been accepted by the company, and those returns. Those are, so now it is very clear. No, those are returns which is again sold. They don't give the money back. You have to buy again. Now what will happen? But still you make a provision, and that buying happens in the next accounting period, and you will recognize in the next accounting period. For the current accounting period, you make the provision for possible returns based on your past experience. That's all. Yes, it has to be done at the year end. Revenue to be recognized on the date of sale. Yes. Yes, you're right, Azim. Okay, now what happens? Revenue is recognized as and when it is sold, revenue is recognized. Okay, so because, and then as an auditor or as a management, they should make an estimate and then they will see how the returns are happening. Okay, these are very common nowadays. Say Amazon has return policy and Flipkart. Okay, every seller, okay, every retailer who's a reseller in Amazon or who's a trader in Amazon, okay, has this as a policy. So kindly bear, and all of them are SMC and they are not non-SMCs. Okay, all of them are SMC. SMCs might be your client. So you please see them. If they may not be material. Okay, so materiality alone cannot cover all of our problems. Okay, so kindly ensure that if it is materially returning, then what will happen? If there is something extra, you don't know. Okay, so for example, in 2020, what happened? There is a lockdown for 40-45 days. When did you return the materials? After 60 days, 6 months also. So what do you say? Your recognition is done? I don't think so. Okay. So these are some of the very critical things, some of practical things also. FMCG sector, Amazon, I can think of. Okay. So this is how we will account for this kind of transaction. Okay. Any other doubts as far as revenue recognition or inventory is concerned? We have a lot of time. Yeah. Okay. Okay, I don't know. For long-term warranty, yes, you will go by that. But for short-term warranty, okay, which product are you evaluating? I don't know. Okay, but which product are you evaluating? I'm seriously not aware of. Long-term warranty is purely based on experience. Short-term warranty is very simple. No, short-term warranty is absolutely nil. Okay, it is not warranty. It is not warranty, Mr. Ramakrishnan. It is not warranty. See, it is an acceptance that if I get that material, I will accept a return policy. Okay. Warranty also holds good. No? So warranty now, okay, TV you buy, you won't get it replaced. Okay, if it is a pure fault, they'll get it replaced. Okay, but say a car service within 1 year, it is all clearly estimated. Okay, AC, AC a short term. There are two types of AC. So some ACs give 5. So they say, what is that, cylinder or something? They say 4 years. Compressor, they say 4 years warranty. Normal AC 1 year warranty. Okay, so it is very clear that until those 4 years, generally they don't expect this one. Okay. Okay. Your view is slightly very close. 7 days, yes, we can wait. Anybody can wait for 7 days, but how will you? But when will you file GST returns? Okay, it's all difficult. Okay, I don't think in a company like Lifestyle, by the time you would have made a 10,000 other sale, that's not possible. Okay, so those are the things that we should also bear in mind. Okay, it's all software driven, and it is not okay, just tally entries. Okay, now the most critical point here is tally. Also, I think we are moving towards an environment where we cannot change entries. Okay, from the next year. Now, what will happen in those scenarios? You cannot post entries like that. Okay, so what is the point in waiting for 7 days? Even for 7 minutes, the government is not accepting. Okay, MCA is saying you have a software which is not editable. Okay, now it is not possible. In that scenario, you will have to go assess yourself and post such entries. That's all. Okay, done. Okay, any other doubts? Why provision for possible return and when it is returned? It will be considered as sales returns. Okay, because we want to close. So because Mr. Kishore, we want to close the books on 31st March. Okay, and more particularly, okay, AS5 says the revenue or the profit or loss for that particular period has to be assessed correctly. Okay, now how do you assess them? Okay, so why provision for possible return? So that is the main reason. So you will recognize as sales return in the subsequent period, not in the same period. Okay, then we are inconsistent here. So that is why we are saying we have to make a provision in that period and then reverse and account for sub sales returns and give a new product. Okay, so that revenue would be correct for the previous period on the current period, on the current period and the next period, or rather that way. Okay, now there's another answer for GST. What will you show us this provision? This provision will be reconciliation items as part of GST or 99C. Okay, answer is very simple. Okay, so Ganesh is having a question. So re-explain applicability of AS. Which AS are applicable to small private limited companies? Can you give draft disclosures regarding applicability given to notes? Okay, I will share some screens. Okay, don't worry. We'll do that once we close our presentation. No problem. Okay. Now we'll move on to the next important standard. So which got recently revised. So this is done mainly with a view to align the concepts with Ind AS or IFRS. Okay, so that there is no big change here. Now there's no big change. The concepts are really so we know what is cost and how it is recognized and all those things. Now we'll get on to the slides. Now what is happening? So what is the objective of the standard? The objective of the standard is to provide accounting treatment for PPE. What are the issues which is addressed by this standard? The standard addresses the issues of recognition of assets, determination of their carrying amounts, depreciation charges, impairment losses. Okay. So here one thing to be very careful. Impairment is separately covered in AS 28. Okay. So this standard says please refer there. But other than that, say recognition, initial recognition, subsequent measurement, others like depreciation amount, everything is covered in this standard. Okay. So after this, AS6 is withdrawn. So AS6, I think depreciation has come into this standard. Okay, and it provides more or less the same set of rules, same set of principles in AS10 itself. Okay. Okay, now. Okay. Fine. So what are PPE? PPE are tangible items. Be very clear in mind. PPE are really tangible items. No other thing can ever be called as PPE. Okay. Intangible separately covered under AS 26. PPE is straight away tangible items which are held for use in production or services or rental to others or for administrative purposes. Okay. And these two conditions are very important. And they are expected to be used for a period exceeding 12 months. That's it. Okay. Now, with this understanding, we'll move on to the principles. Okay. Now, what are those principles? So, what are the useful life? Useful life is a period for which asset is expected to be used, or okay, number of production units. Okay. The first asset is very simple. Say, for example, you buy a AC. AC will generally work for say 5 years. You see, it is not that it can work for 10 years also. Okay, you have an estimated useful life at the time of buying. That is the useful life. Okay. Now there is another thing called tool. So tool is used for say 10,000 times or 1 lakh times. Then this is what is the second bullet point is communicating. Now, what is the carrying amount? Carrying amount is nothing but amount, okay, which is carried in books after depreciation, and depreciation is accumulated depreciation, accumulated impairment losses. That's all. Now, fair value. Fair value is the amount which is determined by two unknown parties, knowledgeable parties, willing parties, and they should get into an arm's length transaction. So this is the price at which knowledgeable parties, willing parties, unknown parties entered into a transaction at arm's length. Okay. So fair value is not clearly defined in anywhere in any other standard. Very important. Okay. Depreciable amount. Depreciable amount is nothing but cost of an asset minus residual value. If there is a subsidy given, okay, reduce that also. Now, recoverable amount. This is anyway covered in AS 28. Okay, net selling price versus value in use. These are some of the basic principles that we should bear in mind. So it will be very important. Now, how to recognize cost? Cost is recognized. Okay, so cost of PP is recognized only when it is probable that there is a future economic benefit and the cost of item is measured reliability. Okay, if these two things are not, okay, there is a small, okay, I'll tell you where. Okay. So first point, PPE says, what is a PPE? PPE definition says it should be used for the purpose of production or rendering services or for usage by others or for using for administrative purposes. And then second, for becoming a PPE, it should satisfy those conditions: usage in production, etc., and then use for more than 12 months. Now, when will you recognize or what is the cost of PPE? Cost is, it is probable that only when it is probable that there is future economic benefit, otherwise you will not do that. Okay, and cost of an item should be measured reliably. Okay. So, okay. Fine. We'll move on. So, what are the cost elements? It is simple, same cost of purchase. Okay, this all will be similar to inventory. So, purchase price plus or minus taxes depending on their recoverability. Okay, directly attributable cost. And what about decommissioning cost? Okay, this is not, I don't think this was there. Okay, decommissioning cost will be capitalized. Okay, now obligation arises either as a result of acquisition or say we have used that asset for say 10 years. then it might arise. Okay, so this has to be evaluated at the initial time, and then the recognition of cost is based on such evaluation at the time of purchasing the property, plant and equipment. Now, so these are the cost elements. What is directly attributable cost? So directly attributable cost will include, these are some of the examples which is given in the standard. Okay, say a set of employees would have worked for the project. Okay, there will be some cost where the company might have incurred to prepare the site. All these are costs which are directly attributable. Example, professional fees. What is the example of professional fees? Not audit fees, basically. Fees paid to an architect. Okay, so will be directly attributable cost, because he is the one who's managing the project in terms of how it is progressing, or whether it is progressing in the way in which we are intending that to be progressed. Okay, but this directly attributable cost does not include these things. Say inauguration cost, cost of introduction. These all are clearly administrative in nature, if you notice. Okay, so we used to generally read sunk cost, or this is not relating to bringing the asset to its present location and condition. Okay, so always we should remember that any cost which is incurred to bring an asset to its location and condition, then it is capitalizable. Otherwise, it is not capitalizable. Okay. Now depreciation. This is simple. Okay. It should be recognized for each period, and then why depreciation is charged on that, I don't think I have to explain. That's fine. So it is nothing but a systematic allocation over the useful life. Okay. Determine. So residual value on a useful life may be reviewed at each year end. And then if there are differences, then please recognize in accordance with AS5. That's all. Now, what is the method? Popular method, SLM, WD. That's all. Okay. Now, if there is a change, okay, now the only biggest point is, okay, first point, second point. Okay, depreciation period. Previously, change in life is always a change in estimate. Okay, just listen carefully. Change in life, change in estimated useful life is a change in accounting estimate. Okay, and after this PPE standard, which merged with AS, which incorporated AS6 and all those things. Okay, change in method of depreciation. Say if you are following SLM and if you are moving to WDV, and that is also treated as accounting estimate. Okay, you might be very well knowing. So what happens? Change in accounting estimate will be from the first date of the financial year in which the accounting estimate is changed. Okay, if it is a accounting policy change, then you will reassess, you will remeasure everything had you been following the old method. Okay, from the date of inception, you would have calculated everything. That is not going to happen again. Now change in method, so change in life, change in method, both are considered as accounting estimate, and this is a critical change, and you don't have to disclose anything extra. Okay, previously if there is a change in accounting policy, then you will say what is the effect of change in method, you will disclose. What is the effect on profit? All those we would have disclosed. So now it is not possible. It is all accounting estimate only. It is a critical change. Kindly bear this in mind. Okay. No. There is a question for you. Land and buildings at certain locations were revalued. Okay. Gross depreciation includes so and so. Now, okay. So the answer here is okay. If there is a revaluation, the revaluation has to be applied for entire class of assets. Okay, so it should not be, say for example, we have land parcels in Chennai and say Vijayawada and Hyderabad, something like that. Okay, now what happens? And the management decides to revalue only in the parts of Vijayawada. It excludes Chennai and other things. No, that is prohibited, not possible. They have to revalue the entire portion of land and buildings. Land separate, building separate. If land is attached to buildings, so land and buildings generally go on hand in hand. So both has to be valued for all assets which is available in the FA register. Basically, you cannot exclude yourself saying no, we will do only for asset and not for others. So this is the main understanding over here. Okay. Now this is another interesting question. Okay. Significant amount. So there is a site development, site and land development separate item in the financial, in the asset listing itself, and no depreciation is charged. Is it acceptable? First, so this is an asset first. Yeah. Now, whether site and land development is an asset. Can I have some answers, please? Okay. There is no response. Sorry. Okay. Okay. Say I'll put my questions differently. Okay. Say a land is there. In that a factory is being constructed, and there is a development activity which is happening. And now there is this separate line item. Now what should be done? Now what should be done? Depends. Okay. Okay. Great. It depends. Development cost add to land. Only land. Why only land? Why only? Okay, I get your answer. So it is site and land development cost. Okay, I get an answer because it is part of was it commission completed? Okay, we'll assume that it is not even completed. Okay, we'll assume that it is completed. Okay, the two assumptions we have made now. Yes, it should be capitalized, Mr. Sharath. I understand it should be capitalized. Okay, but it should be capitalized as what? Why only as land? Do you all say that we should capitalize this only as land? No. Okay, thank you. Okay, we got most of them as land upon construction of the structure to the extent it is identified. Okay, done. So I got fair portions of the views. Okay, now what? So I'll explain. So there is a land of say 5 acres, and these 5 acres are being used for the purpose of constructing a factory, storage yard, and then open space, administrative building, factory building. Okay, something like this. Now what will happen? This land site development expenses are incurred because the land may not be suitable to construct a factory, construct admin building and other things. Now, on top of that, there might be some special requirement for you to have installation of machinery. Okay, pit, something might be required. Okay, these things might be installed. So what will happen? These are qualified and it is all eligible to be capitalizable as directly attributable cost. There is no problem. Now what will happen? This directly attributable cost should be apportioned to land, building, plant and machinery. Okay, in some basis, so that those will get depreciated. It should not go only to land. Land is only land cost. Okay. Now I have a separate question to all of you. Okay, if you take it to land, okay, can this be considered as cost of land for income tax purposes? I don't know. Okay. So these we have incurred only for the purpose of building a factory. It is appropriate to take that to the factory and claim depreciation. Okay. These are some of the logical answers. Or the standard says this is directly attributable cost, apportioned to the relevant assets which are built as part of this cost. That's all. Okay. I have a next question in this same example. Okay. Okay. Sorry. So we will read this answer, then I will have that question. Site preparation costs comprise mainly of uprooting of existing structure, leveling, clearing, and grading incurred to prepare the land for its intended use or for construction there. Agreed? Now, these costs should be suitably apportioned to the land, buildings, plant and machinery, and capitalized as part of cost respective assets as per the requirements of AS. Are you all in agreement with this, or you have any doubts? Please let me. If you're not on agreement, if there are no answers, then I'm okay. If there are answers, then it will be very good. Yes, foundations are part of civil cost only. I would disagree. Foundations are laid in land. That does not increase the land cost. Land is only land, which is sand. You do anything on land to put a structure, and that becomes a structure, no? What about pillars then? Okay, any views? When the factory is yet to be built, okay, then I would have a different question, sir. If the factory is yet to be built, okay, then why will the company incur the land development? Okay, maybe then it will go to land. Okay, but that is very tricky actually. Then we may not incur such a land itself. No, we'll keep that as land. Why will you just keep incurring only site expenses if there is of no use? Okay. Okay. Not to be apportioned to P&M. No, not possible. It is all, see, that's what, it's all common expenditure in nature. Okay, it is all very common in nature. Okay, and pre-construction cost assets would have to be added. It's all common in nature, it has to be apportioned. Yeah, development may get sold. That is in a case where you are developing plots. If you are developing plots, yes, I agree with your answer that this will be added to the land cost, and which is nothing. Land becomes an inventory there. It is not becoming an asset there, PPE there. Okay. So then it is okay. Yeah. If you're maintaining for the purpose of development, it is inventory, not PPE. Until such time the factory building is built, it cannot be capitalized. Yes, it cannot. Until the factory is built, yes, sir, you are absolutely right. It cannot be capitalized. It will be part of capital work in progress. Okay. When you are about to capitalize, then what will happen? This site and land development expenses will be apportioned to the respective assets at the gross value or to the each and every line item. So I'll tell you another example. Okay, this is what we have to discuss. Okay. Suppose a separate project team is there. Okay, assume a project team is there. This project team is exclusively seeing this project. Say the company is incurring 1 crore per month for this project team. Okay, now you tell me, where will you capitalize this cost? Whether this is a directly attributable cost. That should be the first question. And if it is directly attributable cost, can you apportion to say land, building, plant and machinery? I hope you all are able to understand the question. Yes, you will apportion. So yes means, okay, Jayathan sir is saying he is ready, he is accepting to apportion between land, buildings, plant and machinery also. Correct? Do all of you agree? Is there any excluding land value to be apportioned? Oh, okay, interesting, good. Excluding land value to be apportioned. Absolutely correct. Any other views? Okay. Good. So we are clear, right? So this site expenditure, okay, then there are two answers here. Site and land development should be apportioned to land, buildings, plant and machinery. Project team's salary is apportioned to buildings and plant and machinery, not to land. Are we clear? Now, I have one more question. So there is a generator. So you all know that in a new site, there is no power. Okay, we use generator. Great, right? Yes, I agree with you. Now, there's a generator. The generator is used for the purposes of, say, providing power to a lot of other machineries being used for the purpose of construction. Generator is owned by the company. Now, the company incurs diesel for the generator, number one. The company incurs depreciation on the generator. Which one is capitalizable? Everything is capitalizable. Nothing is capitalizable. Why diesel is not capitalizable? No. No. No, it is not running. No, diesel. I agree. You know, diesel. No. So it is not. See, diesel is running expenditure. We agree. Diesel is incurred for the generator for the purposes of a new factory. Okay. Why it is not a directly attributable expenses? Okay. So please differentiate. Okay. So I'm not saying it is all directly capitalizable. Okay. So please evaluate. Diesel, yes, it is running. Diesel is running not because it is running for a car or something. No. I'm not asking for a running factory. I'm asking for a new factory. A new generator is purchased, and we are using that new generator for the purposes of factory, whatever new construction activity, something like that. Okay. Now, whether it is qualified as a directly attributable cost was my question. So in that we incur two. One is the diesel, next one is depreciation. Okay. So the diesel is capitalizable and it will be part of CWIP until it is capitalizable. And then once it is ready for capitalization, then we will apportion to same building, plant and machinery at some proposition. Okay. Now, what about depreciation? It is slightly tricky. So depreciation, we will not charge to P&L. We will take again to this directly attributable cost, and it is apportioned to the other plant and machinery. That's all. No, I agree. I don't disagree. I agree 50% of your answer, Razim, but the second half is not agreeable simply for the reason that don't always think that diesel is running expense. Diesel is running expense. Yes, why that diesel is being used? The diesel is used for construction activity, capitalizable activity. So it is capitalizable. That's all. Okay. What is directly attributable? Directly attributable for bringing the asset to a existing location and condition. So you are using this cost, okay, to build a factory, to erect a machine. Then what will happen? It is capitalizable. Okay. Yes. Done. Any doubts so far? Okay, we'll move on to next standard. Okay, so I'm not moving in a similar fashion because some of the standards are very principle based and there are no examples. So that is why, okay, so practical issues and all cannot be discussed. That's why I have skipped some. So some of them are not applicable. AS5 is there. Okay. Now we will discuss effects of foreign currency operations. Okay. Now, fine. Any doubts you have so far? Fine. Now the objective of the standard is to decide what is the exchange rate we should use and how to recognize the financial statements and its effects of changes in the foreign rates. That's all. Okay. Now, what is a foreign currency? It is a currency which is other than a reporting currency. In India, reporting currency is always Indian rupees. Other than Indian rupees is considered as foreign currency. Foreign operation can be a subsidiary or an associate or a joint venture, and the activities are conducted in other country than in the reporting enterprise. So here, if India is the base, other locations are called as foreign operation. No, there is no. Okay, sorry. We'll discuss that later. No problem. So let us not confuse. Done. So this is how we will recognize initially. So initially, what should happen? Exchange rate on the date of transaction should be taken, and that for that currency, and then multiply that to the reporting currency, account it. This is the initial recognition. Okay. Now, subsequent measurements very interesting. If it is monetary items, say debtors, creditors, and all those things, at closing rate. If it is a non-monetary item, say asset, share capital, those are all at historical rates. Okay. This is also fairly simple. Now, if there is a non-integral foreign operation, so non-integral foreign operation, what will happen? They function independently. They don't depend on this entity or India entity to take daily, day-to-day decisions. What will happen? So when you prepare financial statements, their assets and liabilities has to be reported in the parent entity or some branch entity. So what will you do? Those assets and liabilities, monetary and non-monetary, will be transferred closing rate. Okay. Income expenses at the transaction rate. Exchange, there is a difference which will be accounted as FCTR. Okay. Now, so the income and expenses for the practical difficulty, we have to take the average rate for the particular period. We will take the average rate and we will compute for income and expenses transaction, P&L items. Okay. Now, so these are the main concepts. Now, case studies, forward contract. Okay. So there is a, so I'll read it. Transaction foreign currency are recorded at prevailing rates, monetary items, accounted rates. Okay. Okay. So there is a, this is an accounting policy. Okay. We will read this accounting policy carefully and say whether it is correct or not. Transactions in foreign currencies are recorded at the rates prevailing on the dates of transactions. Monetary items denominated in foreign currency are stated at contracted rates as those are covered by forward contracts. Whether this is correct or wrong. Okay. Any answers? Okay, I'll tell you the answer. See, the point is, see, forward contracts are independent of the underlying contracts. Okay, suppose, so the company is having a borrowing, and against it they have taken a forward contract. Okay, standard says treat the borrowing separately, restate that, and then treat the forward contract separately, and then account in accordance with the guidance specified in the standard. That's all. So because I have a forward cover, standard does not say that you have to restrict to the contracted rates. That is not allowed. Okay. So the accounting policy mentioned above is wrong. It cannot be followed. Right? Yes. Any questions? Now next. Accounting policy. Non-monetary items, fixed assets and loans denominated in foreign currency are restated at the balance sheet date. Very good. The difference on restatement is carried to relevant non-monetary items. Okay. That. But this is okay. No, this is not okay. So why this is not okay? So we are not okay because these items are not restated. Okay. Fixed assets, non-monetary item, right? Denominated restated at the rate of balance instead of being reported at the rate of transaction. So this is the problem. So non-monetary items should be reported at the historical rates. Okay, this is what we said. Okay, now Now, how will you restate at closing it? This is wrong. And again, loans or monetary items, they are saying it is non-monetary items. That also it is wrong. Okay. So accordingly, this accounting policy which is stated is wrong. Okay. So we have given all examples where the accounting policy is wrong. Okay. The simple reason is that, so these are the general things which is widely been followed in many small and medium-sized companies. Okay. So we will show some large entities how they have disclosed before they have adopted Ind AS. Okay. Now, this is okay. Any doubts so far? Okay. Now we'll go to AS5. So AS5 conceptually it is very simple. AS5 requires you to disclose two things. Without even getting, I will explain. Ordinary activities, extraordinary items, prior period items, change in accounting estimates. That's all. Okay. Now what is happening? Ordinary activities, main business, incidental or furtherance of the business, all comes as ordinary activities and reported as revenues. Extraordinary items, purely extraordinary in nature and very not repetitive in nature. Okay. Now, clearly distinct from the ordinary activities of the company. Okay. Very, it should be clearly distinctive. It's all judgment based. And then prior period items. If there is a result of errors or omissions in the last previous financial statements, then it will come as a prior period items. Otherwise, don't disclose that as prior period items. Not everything is a prior period item. Okay. Okay, here generally we see prior period items 50,000 rupees, 60,000 rupees. Not everything is prior period item. That's okay. Materiality can be used to hide prior period items. If it is significant in nature, then please disclose. If it is not significant, then we need not disclose prior period items separately. Okay. Now we'll go to the next slide. Net profit or loss. So this is where a standard is specifying that all items of income and expenses which are recognized in a period should be included in determination of profit for that period. Okay. Unless an accounting standard requires or permits otherwise. Okay. Okay, this is very interesting. I can have questions, but I don't know if I will be having an answer. What exchange rate to be taken for import or export of services? Okay, there's a question from Ganesh. I'll take it up immediately, then we'll discuss AS5. So, initial recognition is import or export of services. Rate given by RBI, Customs Department, or else? Sorry, the answer is simple. You can take exchange rate specified by RBI or by, say, your AD bankers rate. Okay, you take anything, but you have to follow consistently. You have to follow very consistently. Okay. RBI, today you take RBI, tomorrow you take customs data, and day after tomorrow you take, say, HDFC, which is my AD banker rate. That is not acceptable. Take one rate that should be consistently be updated. That's all. Okay. Sorry, let us see if sound is improving. I don't know. So the net profit or loss, it is saying if the standard permits you to disclose in a different period, disclose that. Otherwise, you have to disclose everything, recognize everything in the same accounting period. It is not, there is no leverage given here. Okay. Now, extraordinary items. What is the requirement for extraordinary items? If something is extraordinary in nature, please disclose that separately in the statement of P&L. Okay. What is the nature, amount, and the impact of the current year profit or loss should be disclosed separately. Okay. What is extraordinary item? We'll have to evaluate. It is not from a regular course of activities, ordinary course of business, not for furtherance of business, nothing. Then a classic example or general example which is allowed is winning a legal suit. Okay. Say somebody has put a legal suit and you have won or you lost. If you win a big amount, then that becomes an extraordinary item. If you lose a small amount, then that is not. Okay. Prior period items should be separately disclosed if it is material, and all of them, or if it is material, please disclose. Otherwise, disclose in the relevant line of line item itself. Okay. Change in accounting estimate. If there is a change in accounting estimate, it has to be prospective in nature. Okay, it should be recognized in the period of change, and it will be continuing from the current period to the next period also. Okay, any doubts so far? Yeah, any doubts so far? Okay, so can we see some of the, can I have some questions? I think so. Cash flow statement. Okay, when we have to disclose, okay, I will disclose and discuss in general. So AS3 cash flow statement. Cash flow statement for small and medium sized companies, it is applicable. Now, what are the general principle is that we all know cash flow from operating activities, financing activities, investing activities. Okay, so interest income expenses of a financing company will be treated as operating activities. Okay, so similarly there are set of rules we follow: direct method, indirect method. Okay, so the practical scenarios, I think these are very, I don't think it will have any discussion points for a cash flow statement. It's all very simple in nature, so I have not said. If you have any doubts in cash flow statement, you can ask. Okay, AS4 almost talks about the provisions and other things. It is all covered by AS29, and AS29 itself is a very simple standard. Possible obligation resulting of a possible past event. Okay, you recognize provision. Okay, if there is a probable, then you don't recognize, you disclose it as contingent liability. If there is an income, then you treat it as a contingent asset, and no disclosure is required, no recognition is required. That's all. Okay, so AS4 and AS3 does not require a lot of discussion because it's all very principle based and covered by AS4 is covered by AS29, so no discussion, further discussion is required. AS3 very simple in nature when it comes to principle. When it comes to computation, it is actually tough. Okay, kindly follow the illustrative wherever it is available. Okay, disclose to the extent of with a great detail. Okay, please, you will have to, so where you have to be careful is you have to be very careful in non-cash items, non-operating items. Okay, so that is why generally we do that mistake. Okay, so non-cash items, you may treat that as cash items. Okay, non-operating, you will include as operating. Okay, you may have to include in investing or in operating cash flows. Okay, so that's very critical. Okay, now any questions? If okay, I have one question from John Matthew. If bill for expenditure incurred in previous year is given by the service but in the current year, is it a private item? Okay. See, it clearly, okay. So prior period is not just because it is being given to the previous period is not becoming prior period. So let us go back to the definition and read. Okay. Let us go back to the definition and read. Definition says income or expenses as a result of errors or omission in preparation of the financial statements of one or more periods. Correct? Okay, now let us go back to your question. So they have missed to give some bill. They are giving in the current period. Whether it becomes, no, it won't become. It is not. If it is material, whether it is material, okay, then also I don't think prior period. And if you become prior period, then what will you do for tax purposes? It will be disallowed straight away. Right? You can't revise your previous ITR also. What will you do? Prior period is something which you have seriously missed because of the error. Okay, you have committed an error. Okay, there is a depreciation calculation. I made an error. Okay, I correct it now. Please. Okay, now that will become a prior period. If there is no such error, then there is no prior period. Prior period should be avoided, in my view. Yes, sir. So there is Azim Roy. Okay, so interest and dividend paid received by non-financial entities. Non-financial entities, okay, NBFC, non-NBFC side, okay. Okay, classify under investing. Please clarify with references. Paid and received by non-financial entities. That's what you know. So non-financial entities means they are not in the financial services sector. So it is not their main business. Then what will happen? Interest income will become investing activity. Interest expense will become financing activity. Right? Very simple. Interest paid. Yeah, it will become financing activities. Huh? So the answer is very simple in this case, Sim. So that's all. If it is non-finance, then it straight away in financing and investing activity will disclose. Okay. If it is income, then you will go on investing activity. If it is expenses, you will go on disclose in investing activity. Dividend paid. Very well. Investing financial activities. Okay. Dividend received, obviously investing activity. No doubts in that. Okay. Shall we? Okay, so the most important point is, shall we spend some time in understanding, going through a list of accounting policies in large companies? Okay, so I'm going to show only the financial statements of, say, large companies. Even you can also download and see, say, companies like Infosys, ITC, and then so Unilever. These are the companies which if you go through, okay, you will see a lot of difference in which the revenues are reported. Okay. I will show you, say, some examples. Raised hands. Okay, can we spend some time? Okay, I will share that. I'll open that and then I'll share. Is the screen visible to you? Okay. See, this is a company which is in construction sector. Okay. Look at the way. So this is the statement which you will make in basis of preparation. Okay. So it says the company has followed generally accepted accounting principles in India. Okay, comply with all materials under 133, read together with companies accounts rules, companies accounting rules, everything. Right? They are also saying it has consistently been applied. Now, summary of significant accounting policies. It says use of estimates. So tell me if you have any doubts. Okay. See, they're saying this is, I don't know. So I don't know how many of you seriously write use of estimates. Look at this statement. This is very, very critical. This is very, very critical. Without making this statement, okay, I don't think the financial statement is complete. For example, estimate is there in almost each of the captions. Okay. For example, depreciation is an estimate, or useful life is an estimate, provision for bad and doubtful debts could be an estimate. Okay. There's a lot of places where estimates, provisioning, okay, warranty, so we discussed, provision for sales returns, estimate. Okay, everywhere estimate is there. So what the management is saying? Management is saying estimates has to be remeasured every time. Okay, so that is a necessity. So the management has to reevaluate. Somewhere we read that management has to at least once in a financial year to restate that, okay, they have revisited the estimation criteria and ensured that it is appearing appropriately. That's all. If you can read this, the preparation is in conformity with GAAP. Okay, requires the management to make estimates and assumptions that affect the reported amounts of assets and liabilities and disclosure of contingent liability as at the date of balance sheet and results. Although these estimates are based on management best knowledge, actual results could be significantly different. Significant estimates used by the management in the preparation of include where and all they're giving project report, project cost, revenue. So this company is giving a lot of places where they have this problem. Okay, so look at how they are writing tangible fixed assets, intangible fixed assets. Okay, see they have given the borrowing cost here itself, and then now derecognition. Okay, most importantly, I'll just go down. Okay, they're given impairment, very detailed. Okay, lessee. Okay, now we will leases. We'll see inventory related to contractual real estate activity. It's a construction company, as I told. They've written related to contractual activity, work in progress, real estate project. Now they have another thing relating to manufacturing activity. Okay. Very detailed. So revenue recognition. So they cover everything. Revenue is recognized to the extent that it is probable. Okay, operations, excise duty. So a revenue from property development. Okay, there were conditions before April 2012, and after that there is a guidance note. So they are mentioned the conditions in guidance note. Undivided share of land, group housing, villa plots. So for each of the items, okay, see how the revenue recognition policy or how the revenue recognition is detailedly disclosed. Okay, in a very detailed revenue from manufacturing division, okay, dividend income, revenue from investments in partnership, taxes. Okay, my question to you is that can you observe that there is a huge difference in which these things are disclosed? Okay, this is how accounting policies are generally written. Here, yeah, sorry, I'm not showing this. I don't know. Yes, are we clear here? Okay, now let us go back and say HUL. Okay, I'll open HUL. Yeah. So you could clearly see that it's very clear that we are mentioning that what is the basis of preparation of preparation. Then they are saying revenue recognition. So income from export incentives, risk and rewards is mentioned. Okay, and no effective control, risk of no effective control, delivery. Okay, uncertainty exists, collection consideration, sale is recognized, net of discounts, rebates, those are all mentioned. Okay, income from services. Okay, POC method. Okay, and wherever they have, they are saying significant uncertainty is not there. Tangible assets. Intangible assets, rate, useful life. Okay, provisions, contingent liabilities, retirement benefits, investments, foreign currency translations, operating leases, segment reporting. Yeah, I hope all these things are very, very presented in a very detailed manner. Okay. I hope that this session is very useful. Please ask if you have any questions. Otherwise, we'll finalize. Not a problem. Yep.
Friends, the speaker is available. Because if you have any questions, please. Yeah, Arvind Gupta ji, you raise your hand. Please unmute yourself and you can.
Okay, you want that now? Okay, I'll have in my own. 1 minute, sir. I will just open that and then I'll share my screen.
Friends, the PPT will be shared by our session speaker. Then,
Yes, sir. So, yeah. So, Mr. Ganesh, you kindly refer to this disclosure. Okay, this is for one of the company which we prepared. Okay, first states. Okay, it says the basis of preparation, and the second says this is a SMC. Okay, and accordingly, the company is accordingly applicable to small and medium companies. That's all. Okay, and then we are also stating. This is how I think we will have to disclose, sir. Yes, yes, I'm getting some lot of queries now. Yeah. So there are something based on applicable for. Okay, we want me to type and send. I'll give you that. Not a problem. Okay, please share. I will share the PPT. See, companies, yes. Okay, someone has asked for doubts on tax audit. Yes, it is very much applicable for tax audits also, sir. See, I will tell you. So there are differing views here. Okay, but I'm trying to explain. Okay, let us listen. So, see, the point is we are preparing financial statements. Okay, financial statement has to be prepared based on accounting standards. Now the second question is, for tax purposes, we anyway have a separate ICDS, and impact on ICDS should be computed for the purposes of tax computation. Okay, so what we are supposed to follow, or what the management has to follow, is only accounting standards. Okay, that is very, very clear, even for tax audits. Why not? It is all accounting standards only, right? Okay, then the impact of ICDS has to be analyzed to determine the tax expense, and that can be disclosed separately in the tax audit report, which is in Form 3CD and not in accounting financial statements. Okay, am I clear? Am I clear, sir? Okay, any doubts? Okay, sure. Thank you.
yeah, Ravind Gupta ji, you raised your hand. Please, if you want any query, please unmute yourself.
Sir, you are on mute, I think. Mr. Arvind, sir.
Sir, kindly unmute, sir.
Sir, you can unmute yourself.
Hello, sir. Good evening, sir. Arvind Gupta this side. In
Sir.
case of any demand raised by GST or income department or the department for the earlier period, taking.
Sir, I'm sorry, your voice is not clear.
Your voice is not clear, sir.
Demand raised for the earlier period, but
Yes.
after the balance sheet date. Hello, sir. Am I audible now?
Yes, audible, sir. Otherwise, you can chat box. You can send a message.
Correct, sir. That would be better. Yeah.
Just a minute. Am I audible now?
Yes, it's good.
Yes, sir. Perfect.
Am I audible now?
Yes, sir.
So demand raised by the income tax department or GST department for the earlier period, but after the balance sheet date, how this to be taken care of?
Yeah. So this question is exactly from AS 29. Okay. The point is, this is past event. Agreed.
Yeah.
Now, possible effect is also communicated demand. So it's an adjustment to the financial statement. You will make a provision if you are agreeing to it. If you're not agreeing to it, then you will, if you are filing a, say, appeal or something, and if you are confident of winning, then you will disclose that as contingent liability. That's it.
So it is to be covered under the notes on account as a contingent liability.
No. Okay, I will answer with the help of accounting standards, sir. Okay.
Okay.
There is a demand with respect to the previous years. Okay.
Yeah.
And previous year is past event by the standard. Number one. Number two, there is always a possible result. The possible result is a demand, and the demand, there is a demand in front of you in the form of an assessment order. So now, if you have evaluated to make an appeal, then you will disclose, then that becomes probable. Okay. And then you will the liability. And if you accept and you don't have any option to appeal, and if you believe that you will lose the case, then you will make a provision.
Okay, thank you.
Okay.
Yeah, okay.
But the point is, we will have to disclose at least as contingent liability. But in audit report, if you had paid any demand, then there also you will say as disputed demand, that disclosure will come there.
Okay.
In audit report,
Thank you.
come as disputed.
Thank you, sir. Thank you.
Yeah.
Thank you.
Yes, sir. Any other questions?
Friends, if you have any questions, please text in the chat box. Otherwise, you can raise your hand, or you can unmute and you can ask the questions. Otherwise, we will close the session with the permission of the speaker and chairman, ma'am, chairperson, ma'am.
I think there are no.
Jagdish sir, shall we close?
Yes.
Yes, sir. We can close. Thank you. Thank you.
Yes, thank you, sir. Sir, thank you very much, sir, for your extraordinary presentation. Before going to the further procedures, you had a closing remarks of the total 360 degrees program and today's session also.
Well, thank you, sir, for your excellent presentation. All the sessions are very informative and knowledge enriching. We hope the reason for which we have organized this refresher course have reached its purpose, as the members joined in good number for all the sessions and participated very actively through posing plenty of questions to the speakers. and also speakers also answered with very much patience levels with all the questions, and all the speakers have delivered their presentations in excellent way by maintaining the same energy levels till the end of the sessions. Hope the sessions would have value added to you all and help you in discharge your professional duties as well. Vijayawada branch is always stands forefront in conducting this type of programs, and all your contributions shows patronage to the Vijayawada branch. And we have esteems and regards to all the participants and the speakers, and we wish you meet in the coming programs. Thank you, Manindra.
Thank you so
I
much.
request Vice Chairman of Vijayawada branch to extend a formal vote of thanks.
Yes, ma'am. Thank you, ma'am, your kind words and closing session. And I feel I thanks to the today's our resource person, CA Jagdishan sir, for exemplary presentation on AS2, AS1 and 2 and 3, 4, 5 and 7, 9, 10, 11. He started with a tough standard with 11 and concluded easy topic and easy standard, but it is one is the very toughest standard, sir. Basically, one is the hard for the all standards. You raised the first question itself, the starting, and it is your tech knowledge shows to our members, sir. I thank to each and every member with the committed participation today's also, and we are on behalf of the Vijayawada branch. We are utmost thankful to our bottom of my hearts for the refreshed course. And we are also personally thanks to the chief guest of the CA and Talati sir, vice president of ICA, and chairperson of the CL and CCC, ICA, it's Priya Kumar ma'am. She is the behind the total program. And we are also thanks to the whatever the five day speakers. First day Jaman K. George sir and Subramania Sharma sir, and second day Ramaswamy sir, and third day Chinnaswamy Ganeshan sir, and fourth day Mohan Lavi sir, and today's our resource person Jagdishan sir also. And friends, actually I thank to each and every member with your committed participation. We completed with grand successfully conducted of refresher course on 360 degrees of annual report for these 5 days for enhance of your knowledge. Friends, finally, Vijayawada branch is always planned to conduct the programs for the benefit of the members, as well as we will meet in future with another bunch of programs which is required for the members to enhance their knowledge. Now we are going to be signing off today, and thank you and each and every member, and thank you for your motivation to also. Sir, today you have in chat box also a lot of pouring of messages are also there. It is a thanks to Vijayawada branch. Thanks to look forward to sir more such sessions. Definitely, sir. Your dream, definitely we will do it. The branch is for the service to the lot of fraternity of our members. Thank you each and everyone. Thank you, sir. We are going to be signing off. Thank you. Good night.